Welcome back, ladies and gentlemen. Today we're going to be exploring the realm of the Canadian dividend stock sector in general, because most of you seem to take a real big liking, as most of you are probably Canadians, to dividend stocks. And for those of you that aren't aware, just to give you a quick preview, first and foremost, if you haven't seen my portfolio, it's currently worth around 404,000. My portfolio will not remain like this in perpetuity. I'm evolving, I'm growing. For those of you that are OG to the channel, you've seen this, and I'm hoping as a community we can offer perspective on the comments and questions so many of you have been asking me about Canadian dividend stocks. We're going to be reflecting on in this live stream. So for those of you that are new, you can take a quick review, pause here, and just kind of equate some of these stocks and maybe take it into perspective with your own investing. But the first thing I want to shout out is thanks so much to the patron members. The questions and comments patrons have asked, I'm hoping as a community we're going to be able to answer them. If you guys want to support the patron, join my private WhatsApp group. The link is in the description below. But this first comment in question, I think is a real nice one just to ask you guys in general, being probably at different ages in your investing career. Because again, investing isn't a one size fits all shoes. So this is a very intriguing one. This comes from Chris. I did try and make it a little bit more private, so I'm not just spewing out any of his information here. But he says, hey, I have been investing through an advisor for quite some time, and I am not seeing the returns I would like. New to this self-investing, and like your idea of ETFs being a large part of your portfolio, struggling to know where I should be investing for tax purposes among registered and non-registered accounts. Also, do you think it is time to start buying the ETFs, VDY, and BOO, or wait? Steering me to the correct information would be greatly appreciated. Note, I'm over 50, so I think this type of investing is my best bet. Thoughts? So I'm going to offer my personal opinion on this, but again, I'd love to know what everyone thinks so we can offer Chris some very broad insights here. So I would look at investing probably similar to how I would be doing it for my parents, which probably wouldn't be as single stock or growth oriented. But again, if you're looking at tax advantaged accounts, the first thing you got to do as a Canadian is max your TFSA and max your RSP. Just get those things maxed out, because that's where you're going to get those tax-free dividends coming into play. Without question, that's the first thing every single Canadian should do. But when it comes to buying these ETFs, I don't know if you invest with US dollars, but maybe VFV might be a better solution, and maybe pick a time period to start cost averaging into them. You should always be investing no matter what. I wouldn't really be worrying about what the market cycle is currently doing. But in that note, we're going to be going over a bunch of ETFs and comments about Canadian ETFs in this video that you might find could suit in your TFSA or RSP. But honestly, you kind of got to ask, how much money are you putting away? How much do you have saved? How much do you need for your retirement? For my parents, we look at a broad variety of safe investments, from GICs to these dividend ETFs we're going to discuss. And we're more or less focused on getting the yield that's going to get them to retirement. Because basically, at the end of the day, you're probably looking to retire in your 60s and 70s, giving you maybe a decade to 20 years of investing ahead of you. So you kind of got to ask where your goal's at and where you need to be by that time frame. Because with dividend stocks, you don't have to worry about the volatility of the market. You can just rely on the income and spend it as you please without touching the initial investment, which is a route that I think would be better in retirement than perhaps using a financial advisor. But for some people, self-directed investing is a bit concerning. Like in my family, some of my aunts and uncles would rather use investment advisors, and I've kind of steered them toward Edward Jones and a few other, financial advisors that I personally like, people that I've talked to, and they follow the same kind of philosophies that I do. So I'm going to ask everyone in these comments, and I feel like we're going to get a lot of variety of comments. Kyle, do you worry about if your RSP gets to over $1 million? I don't think that's going to happen anytime soon on my end. It would be nice. And honestly, when it comes to RSP, pulling money out of it, it's much better to do at retirement, because it gets taxed at your nominal bracket rate when you start pulling it out. So when you're not making as much income, it's best to start pulling it out on those years, so that way you're not getting crazy taxed on that income. But what's he saying here? We got 5.28% RRIF withdrawal at age 71. Yeah, there are a few other retirement accounts. My dad has one. What is it, a Libra? I can't remember the exact term of the account, but we hate it because trying to get money out of it become a technical nightmare. My advisor for 2022 did a 0.38% in my RSP and a minus 12.5% of my TFSA. 2022 was a rough year. I don't think anyone made money, but I'm going to say that's not the worst loss. To get a positive in your RSP and only down 12%, where the S&P was down like 20+%, probably pretty good. That's not the worst. What are your thoughts on HYL? We'll talk about some of these in a sec, guys, but I just kind of want to fixate on these questions and comments. So I'm going to answer this more in depthly on Patreon. So thanks for that comment, but let's move on, because I think you'll get some insight from these other questions. So this gentleman here, the Noble Lefty, commented on my Canadian dividend stock video that I posted yesterday. And he says, I hold and keep buying XEI, ZRE, and XIC. These ETFs are really fascinating to me because I think they really exemplify the Canadian markets. And again, you don't have to buy what I'm buying. I think there's a lot of insight in these. So let's take a look at XIC first and foremost, the iShares Core S&P TSX Cap Composite. This thing has been a real steady Eddie against the market here. And just taking a look at some of the holdings and some of the fees and just my general thoughts and opinion on it, because this is a BlackRock investment. And I do like they show the hypothetical $10,000 investment since inception here did pretty well. I mean, back when was this incepted? Probably in the early 2000s. You'd have a $40,000 return. Dividend income's very stable. Is this a monthly paying? No, this is probably just your standard S&P TSX kind of ETF with a 2.91% dividend yield. Again, this is something that you'd be buying just to get Canadian exposure where you're not as worried about the income. The expense ratio is extremely low at 0.05%. So that's what I really like. And we can kind of see the exposure. We'll do some comparables to maybe some of the other ETFs here, but just take a look at this because again, Royal Bank, TD, you're just getting that broad-based exposure with a little bit better sector diversification, 31% financial, 17% energy. This is just a good rounded ETF for somebody just looking for long-term growth and some dividend income, just cherry on top of the cake from the Canadian markets. But then he also mentions here XEI, the iShares TSX Composite High Dividend Index ETF. This one, favorably, you could take VDY or this one. We'll kind of do a comparable with VDY. This one, let's just share the tab here quick so you guys can see this. XEI is a rather intriguing one. I find the dividend income here looks a little bit more volatile. Then again, VDY pays monthly and it looks volatile, but I think there's a little bit more stability and we're starting to see a lot of growth out of the VDY, but it's super concentrated, I think, in comparison to this. And this one has a 4.58% starting dividend yield with an expense ratio of about 0.2%. So it falls in line with Vanguard because VDY also charges a 0.2%, but we'll notice this is more or less equal weighted. So you're getting, Suncor, Barrick, Canadian Natural Resources, Royal Bank, all these sitting at around a 5% holding, BCE, TELUS, all these really fabulous Canadian stocks, giving you some good equal weighted exposure, 30% financials, 30% energy, 13% utility. This is what I would call like a retirement kind of a stock. This is a beautiful little investment for trying to collect some monthly income. I really like this ETF and it probably pair very well with VDY. Now we'll notice VDY over the last 5 years has had better capital gain performance. And the reason for that is the wicked concentration this stock has. I wouldn't put all my money just into this ETF purely because of the risk and the concentration. But again, same expense ratio. The 12-month trailing is 4.42%. But honestly, I think that yield is now like 4.7%. But again, you guys know VDY. We talk about it relentlessly here. If I can scroll down and just find the sector exposure, you'll see the concentration in financials and energy along, obviously, with Royal Bank, Toronto Dominion Bank, and Enbridge making up like 30+% of this entire ETF. So when we look at comparable performance, I always find as a monthly paying ETF, VDY does excel exceptionally because of that concentration. And Royal Bank is a pretty renowned Canadian dividend stock. So I don't think it's going to go anywhere. But obviously, if there's some big hit to the financial sector, you're going to feel that pain at some point. But those are kind of the stocks that he's taking into consideration. And honestly, I think, maybe for his own risk tolerance, I don't really know his perspective or income, but these are really great diversifying ways to get involved in the Canadian stock market, get that over 4% yield, a lot of it paid monthly. Now, for my personal portfolio, as I've talked many times on this on my channel about, is REITs. I really love the Canadian real estate sector, and I've been having a hard time about how I want to get my exposure in the future to it because, like I said, we still have exposure to RioCan, things like that with my fiance's portfolio. I sold out of it to max my TFSA to primarily fixate on VDY, but I'm either going to be buying back my REITs individually or I'm going to be looking at something like the BMO Equal Weight REIT Index. Now, the performance of this, the problem is like I like growth because I'm so young right now, and the real estate market isn't a place where you're getting that exceptional growth, but you are getting a pure place of stability when it comes to just cash flowing monthly. And I really love this equal rate weight. Well, actually, this is we're doing some comparables here because ZRE is one of the ones we're going to look at, but there's VRE, and I want to talk about why I love VRE so much. But these are the two that I mainly look at with ZRE, and we'll just take a look at the share tab. The thing that I hate most about these Canadian REIT ETFs is the insane expense ratios on them. You're getting this really nice 4.51% yield, but you're losing that 0.5% just to the management fee, which really kills me inside and has kind of always geared me away from buying these. But we'll do a comparable with VRE in a second. But when we take a look at the holdings in this one, and again, it's just the 10K comparable just performance. If you invested 10K Let's do the 10-year outlook on this guy to see what we would get. So from 2013, 10-year outlook here, you'd be sitting on about 20,000. So you double your money in about a decade. And this is a cumulative return, including the dividends. So not just the cap growth, which again is a very healthy return over a decade. But again, you can usually do a lot better than just buying the broader indexes in Canada or the US, or again, fixating on some of those growth stocks like I'm trying to do with TSM. But when we kind of scroll through here, just to take a quick peek, and let me just double check to make sure everything's being screen shared. And then after we get through the REITs, I'll answer some more of your questions there. But just taking a look, guys, at the holdings in this, let's scroll down and see if we can find them here. We can see, again, primarily being equal weighted in Summit Industrial, Dream Industrial, Inter-Rent Real Estate Investment Trust, Broadwalk Real Estate, First Capital. These are a lot of REITs that I analyzed. We got RioCan in here. I don't like being in an equal weighted Canadian REIT ETF. I try and avoid these. They're great for retirement, but they're not great, again, for the growth metrics or finding some kind of comfortability, because I do overanalyze individual stocks a lot. And when I analyze a lot of these ETFs, I'm always looking for the ones that fall in suit with my investment philosophies around the real estate market. And I've kind of fallen in love with the Canadian capped REIT ETF, BRE from Vanguard. Though over the last 5 years, it's only up 7%, whereas ZRE over the last 5 years is up 18%. It hasn't been performing nearly as well, which again is kind of a turnoff, but I can't get over the holdings in this, because you got Canadian Apartment Properties at 11%, RioCan at 10%. You got First Service Corp, one that I'm not as familiar with, but Granite I absolutely love. Summit Industrial is amazing. You got Choice Properties, Smart Centers is in here, Allied Properties. These are all incredible REITs. I've owned a lot of these individually over time, and just taking a look at the expense ratio and the dividend on this, you're getting 4.75% and a much more reduced management fee of 0.35%. It's about, it's 15 points less than ZRE. So if I was looking for stabilized income, this REIT is becoming very attractive at the discount that it's currently trading at. Eventually, I'm thinking about adding this one because I really lack that real estate exposure as it stands in this current moment. So this is one I'm going to be analyzing for some time. I usually don't like paying much more than 0.2% in a management fee, but you're either going to be buying REITs individually, which REITs are already like ETFs. So I've always been battling that in my head. Are you better off just buying the individual REITs themselves, or are you better off just buying the index and cost averaging and letting the drip just kind of do the work for you? Now, at the scale of my portfolio, I've been much more leaning into these ETFs. But let's take a look at some of your questions, comments. Kyle, do you use Horizon ETFs for your corporate investments to keep dividends low and maximize taxes? So corporate investing is something I don't talk about as much, not only for protection and privacy, but it's something I should talk about more, because it's a fascinating realm of just not paying taxes on dividends. But most people think that you're overtaxed in corporations because you get taxed at 50% on passive income. So you lose 50% of the dividend if you're just holding dividend paying stocks in a corporation. But you can completely waive those taxes by paying the dividend out as like a payment to like myself, or paying an employee, and which you can just drop it in an RSP or something and pay no tax on it. But no, I don't specifically look at Horizon ETFs. I do analyze a lot of their ETFs. It's kind of a newer investment company. I don't think they've had that much of a standing in the markets compared to like Vanguard, that's been around since like the 70s or 80s. But Horizon does offer some interesting ETFs. There's one I look at called the UTIL. It's a utility ETF. I do find that one kind of interesting, but I don't really buy too much of the Horizon products. If you need income, they are worth looking at, but I'm not sold on them for long term. You will lose out on massive growth. See, that's the differentiating idea of like, are you looking for the income at a retirement age, or are you looking for growth? Because if you're kind of at my age, you're probably more proponented to the growth. So you're trying to balance those dividends with the growth. Let's just take a look here. We'll get through a few of these. Can you have income generating funds like HYLD or RIFF? And if you're making 12% yearly from funds in your RIFF, can you, in theory, never touch the principal and still meet the requirements of 5.28%? This is a confusing comment for me. HYLD, these option ETFs, I tend to avoid because I don't really need the income today. I know people in retirement love them. I wouldn't make them a huge percentage of your portfolio because statistically over time, they do tend to underperform. I'm going to have to reanalyze this question and come back to it at some point to see if I can offer more in depth. The RRIF keeps growing until plateaus at 20% at 90 years, I think. But yeah, it can keep growing. I got to look into some of these other retirement accounts you guys are discussing, because I really only use a TFSA and an RSP. Yeah, so like your dad, I have a Lira. Yeah, we're dealing with that account, and it's a hell of an ordeal to get the money out of it. I've never really heard of these other retirement accounts. I don't pay attention to them as much. So, I'm not too geared into them. But let's get into another comment and question here, coming from the YouTube video of my Canadian dividend stock. Sean Smith says, great video. I'm about 25 years from retirement. I keep buying the Canadian banks. Can't bring myself to buy anything else. I'm dripping 12 new shares every quarter of the big five. Probably not a smart move, not much diversification, but I don't lose sleep. So this is such a funny comment, in my opinion, because my neighbor, I have a lot of discussions with my neighbor about Canadian banks. He only holds Canadian banks basically for stocks in Canada. And he's like, why do I need anything else? And that's a really good debate. You could take that in many different directions. For me, I need more diversification. But honestly, there's a few ways you can go about doing this. Personally, most of the ETFs, there's not many Canadian banks. So I don't know if you necessarily need an ETF to buy the Canadian banks individually, but I do like the BMO Equal Weight Bank Index. This thing has been a steady Eddie. It's been an outlier, a definite outperformer in the Canadian market. It's got a lot of history here. And just taking a look at the weightings in this and the fees, the ticker is ZEB on this one. The expense ratio is falling in line with my comfortability mark of around that 0.2% mark. And you're getting a 4.65% yield. And just taking a look at that 10K investment over the last decade, it's kind of wild to think that would be worth, at the peak, mind you, would be worth around 31,000. Today it's worth about 28, 29. So you're definitely outperforming the Canadian real estate ETFs, right? Like, this thing is a marvel because the Canadian banks are world renowned. They've outperformed during recessionary periods. They're definitely better performers than US banks during volatile markets. But taking a look, you get National Bank, Royal Bank, Bank of Montreal, Toronto Dominion Bank, Bank of Nova Scotia, Canadian Imperial Bank. If I was younger, I'd be more inclined to buy these individually. I don't see the necessary point of just having an equal weight 5 banks in an ETF and pay somebody to manage that when you could probably just do it yourself and then just reinvest the dividends. We have exposure to the individual banks, with my fiance, and Royal Bank being the largest position in VDY. And I have a huge percentage in that. I think it almost makes Royal Bank my second largest position to TSM. But yeah, that's an interesting debate. The Canadian banks are awesome. I don't know if I'd have that comfortability though to just dump it all into just the Canadian banks. But I've sold some VYM and we'll move that money into VOO. VOO, VYM I used to hold. I gave up on it for SCHD. I think SCHD falls in similar performance with VOO, but you're getting like a 3.7% dividend yield today, which is beautiful. But again, I still have to get that S&P 500 exposure. So I do like VOO. If you're Canadian, VFE might be a better proponent if you don't utilize U.S. income. My parents sold their farm and are building a new house. They will pay cash for the build and have zero debt. They will have 400K to 500K left over to invest. What would you do? So if your parents are in retirement, I would honestly say the same thing that I'm saying to my parents. You need to look at stability and the goals that they are going to be required to enjoy a comfortable retirement. So they should be getting pension at 65. So maybe figure out what their pension is going to be, and then take a look at what you can lock in for maybe 6, 12 to 24 month GICs and have them rolling over every month. So you just take maybe 50 grand and every month buy 10 grand of a 6-month rolling GIC. So that way they can start cash flowing it after the 6-month period and that lockup comes due. That's one thing that I've considered for my parents, but we're also looking at all the ETFs that I'm talking about here. Because again, my parents, they don't need to manage individual stocks. You don't want the risk or the volatility of growth stocks. They're not going to draw against their investments. They're going to utilize their TFSA. So you just really want to look at, tax efficiency and getting to that place. 500 grand, if you can make even 4%, right? I mean, they're going to be bringing in 20,000 plus you're going to be looking at your pension, which could probably bring in another 1,000 to 2,000 a month. So they could be in a very healthy place, bringing in easily 35 to 40K a year, which would hopefully cover their expenses considering they have their house paid off. So their expenses should be very nominal at that point. But retirement is a scary thing to try and deal with the markets because diversity really matters and stability of income really matters at that point. So you want to start looking at that diverse portfolio of bonds, GICs, dividend ETFs, perhaps getting some US exposure, some global exposure with dividend companies. And then they don't have to worry about drawing against cap gains. They can purely just spend the dividends. But that's the way I like to think about it. Some people in retirement, maybe if you're a Dave Ramsey fan, you might want that growth and you can just pull some money out, maybe something like a Berkshire Hathaway. If you want some more tax efficiency, if they're going to continue working part-time, perhaps a lot of things can come into play there. Just transferred into wealth, a simple and more comfortably dollar cost averaging into VGRO. CIBC fees were killer. Let's take a look at VGRO. We'll bring that up here. VGRO. GRO stock. I'm not sure if I'm familiar with the Vanguard Growth ETF portfolio. This is an interesting one. 5 years, 27%. Let me just take a look. This one looks relatively new because there's only history till 2018. But let's just take a look to see what you're buying here, brother. On Vanguard, we can see you're paying a 0.22% management fee. Not too bad. 2.17% 12-month dividend. So not crazy dividend yield there. But let's see if this will load. Probably because I'm live streaming. It's just going to lag all the way to hell here. Can we scroll down and see the holdings? Did I scroll too far? No, here we go. So you're getting, oh, wow, this one's very diversified. So you're getting Apple, only 1.7% being the largest position next to Microsoft. Royal Bank in here, very intriguing. Toronto Dominion Bank, Enbridge. So this looks like a very intriguing mix of global diversification here with some Canadian, US. This one, again, it seems more like a retirement stock. I don't know how old you are. But typically I would want, maybe if I was younger, I'd want something more concentrated, just because the growth, man, you need that growth. This is way too diversified for my comfortability. Sometimes over diversifying in an early investing stage can detriment some growth. But who knows? I'd have to look deeper into this one just to see where you're coming from with it. All in all, I'm going to take a deeper look for sure. But let's get back into some comments and questions here. What are we saying here? Vic, Luke, lock it down to get decent interest for now as new builds have unexpected expenses. Yes, I would agree. Housing can be a very detrimental cost. I know you guys should go check out what's the retirement channel I follow called? I shared it yesterday in the comments. Man, I wish I could remember. I might look it up just to show you guys at the end of the stream. But there's the people I follow that have retired and they talk about housing expense, and they actually sold their house and moved into a rental unit so they don't have to deal with all the unexpected expenses. They don't have to deal with the maintenance and shoveling the driveway for snow in the winter, and they don't have to deal with the luxury of saying, I don't like the floors, I'm going to put new floors in. Because you just end up finding things. Homes always come with crazy extra expenses and just things you want to fix and do and make it look pretty. But depends on what you want. Most people want to travel in retirement. Like my uncles, they do cruise ships. They were travel agents their whole life. So they literally are, 2 or 3 times a year, they're on a cruise ship for like a month going all over the world. And they have a very intriguing perspective because they live in Toronto and their rent is insanely cheap. They've been renting at this place for like 20 or 30 years, and their landlord they know so well, they're only paying like $1,600 a month or something for their downtown condo, which is brilliant, but they rent so they don't have to deal with the problems. So I'd be careful with home ownership into retirement. It's something my parents want to do because they're looking to sell a farm as well, and they're going to be probably buying a house. But again, it just depends on preference. My parents are probably they're kind of like rooted to where they live, so they might travel once a year, but they're probably more inclined to want to own. But that's a very inner perspective thing depending on what your retirement might look like. A few more comments. Why people don't use Mogo Trade? Cheaper than Wild Simple. I'm not trading too much. There's a lot of like low commission. I think Quest Trade's good. Interactive Brokers is good. If you're not like buying every single day or something, I don't worry as much about the fees, even though I'm paying a huge amount with Royal Bank and Scotiabank. But I do, I don't mind it as much because I'm usually investing at least, a couple thousand plus at a minimum investment. So, $5, $10 fees, not the end of the world to me. Smart Centers reports earnings today. Can we break down of their financials? Did Smart Centers post today? I really didn't think we were going to see the REIT earnings till the end of the month. Smart Centers earnings date. Let's take a look. Smart Centers. Yeah. Okay. So it looks like we are going to be getting an earnings call, which is pretty interesting. So that one came out early. It looks like it's scheduled for Feb 9th. It's Feb 8th, but it does say the earnings calls today. Actually, let's just pull it up. Maybe we can take a quick look because I'm going to be doing a specific video on these earnings because one of the things that's just making me take a breath from the REIT market is just to see how it's performing in this high interest rate environment. I might just pull up their CEDR because this seems to be, let me agree to this, see if we can find it on here real quick. We don't want annual reports. Let's just go into press releases and see if they dumped us some earnings. We got the distribution. So here's the fourth quarter earnings call release. That was the announcement of the earnings release. Just go into CEDR and see here. If you guys don't know, maybe I'll just do this quick. Might be easier. Smart Centers, CEDR. If you guys don't use CEDR, this is basically where all the companies is. Smart Center's not posted on CEDR. I'm having a hell of a time here. Should have pre-planned some of this. You know what? Let me just go back. If you guys can find the earnings call, drop it in the description below because it should be in the press release. Is it an annual report? I'm not seeing it just yet. Maybe they haven't been posted. Did you see the earnings post, man? let me know. Maybe I'll do a video on this specifically, but typically it'd be in the press releases or quarterly reports, but I'm not seeing it here just yet. We just got the distribution and the fourth quarter release. But again, if I click on this, it's just going to tell me that it's going to be set for that February 9th. So it doesn't look like we're getting it until Thursday. I don't know why it's posted for today on Google. So there's a bit of an error there, clearly. But outside of that, I do want to answer one more question here, because this one's very intriguing, I think, because it's a fun perspective on how things can change over time. So let me just pull this up real quick. So I did reply to this one. I try and reply to most of the comments that I get on my YouTube channel, but you have an impressive portfolio, but you don't actually invest in individual stocks for dividends. So I used to. I'm going to try and answer this in a clean way, but I replied to him saying I only own one single stock that doesn't pay a dividend. That would be my Aduro small cap. Actually, I own a couple stocks, but they're not publicly traded yet. I got into some venture capital stuff that's still got to come public. We'll see how that goes. Maybe make a video on it later down the road. I invest for long-term stability, growth, and dividend growth, mostly through ETFs since 2022. I figure at scale, VDY gives me the exposure without owning 10 or 20 dividend stocks. Too much management. Thanks for the comment. He says, so it's better to not bother with individual stocks. I just don't understand why you promote individual stocks when you don't invest in them. Better to tell everyone to just invest in ETFs. It's just an opinion. I think your site is great, so I do appreciate it. So this again comes from, a changing opinion at scale. So my portfolio over time used to only be, actually in the early days, I try and remind people, when I wasn't making a lot of money, when I was bringing in maybe 30, 40 grand a year, I was really relying on individual stocks to propel my income. And I only held two stocks. The first two stocks I ever bought was Northland Power and Canopy Growth Corp. And I don't think if you're making a huge amount of income that you need to really fixate on ETFs as much if you're in your 20s. If I was in my 20s, risk doesn't mean anything anymore because you have such a long time horizon. Tesla, Shopify, all these great growth companies will work themselves out. So take the risk early on, because I don't think you have to take like broad-based investing as seriously until you have a lot of money or you're getting later in toward retirement. So as I've scaled, now I'm into my 30s, a lot of individual stock picks turned out very well for me. You might recall coming into 2022, I was mostly exposed to a lot of individual dividend stocks. Like I primarily just held dividend stocks, but I came into this place of real confusion because I just couldn't keep up with it. I couldn't manage it. It just seemed like a lot to briefly review a company like Pfizer or briefly review Verizon and be like, okay, I'm going to buy this because of the yield, and then just set it and forget it. I don't think you can set and forget individual stocks because over very long periods of time, it's important to manage it. Whereas if you have less money, you're going to be very fixated on the couple stocks you're buying. But at scale, you're not going to put $400,000 in like 3 to 5 companies. You're just not going to do that. And I don't think anyone can properly manage an ETF of 20 to 40 plus stocks. I mean, you look at like PPCE and a lot of the dividend investing community, I don't think that perspective is going to actually yield really good long-term results because you're just not going to manage that many companies correctly. Like I missed Algonquin Power and Utility Corp. We got crushed on that one, man. That one dropped 50% after they mismanaged their debt. I didn't know that was coming, right? So it's easier at scale to let the ETFs manage the stocks and then kind of take 10% of your portfolio and try and look for something that can excel you. So that's why I bought TSM, right? Like I basically took a break at the first quarter of last year, mostly bought ETFs. And now this year, I've been looking for those outliers of stocks that would work for my portfolio that I think can give me better than S&P 500 returns so I can keep outperforming the market and excel my retirement. So I can kind of reach that financial independence to retire early, right? So I like TSM. I'm still looking at things like Tesla. I'm still looking at things like Shopify. I just haven't got to that philosophy or that place in my heart where I'm like, I'm ready to buy this. I think it's a good buy. Now, obviously, Tesla at $100 is probably a good buy. Who knows over the long term, right? But for me, TSM was just a clear buy, and it fit well as a global-based company that's not in China, it's Taiwan, and I don't have much global exposure, so it fits into my portfolio in a lot of different metrics. I think the value is great. I think the growth long term is going to be there, and I'll analyze it, and I continue to pay attention to it. If something changes in the near term, perhaps I might end up selling it. But same on the Canadian side of the border, right? I still want my real estate exposure. I'm just waiting right now, watching some REIT earnings, paying attention. I might buy the ETF. I might buy individual REITs again at some point because I want to keep the yield growing. But for now, I'm very comfortable with where I sit, and it's obviously going to continue to change over time. This is why you have to figure out what works best for you. And just taking a broad view of the market real quickly to see where we sit before we finish off the live stream. These are the days that I've been waiting for because I got really aggressive with TSM. It kept rallying a lot. I'm still hoping it pulls back, perhaps buy some more. But the market went too aggressive too fast here, guys. And a lot of you in my chat group have been like, this is great. Everyone's loving it, but I'm just I kind of get bothered by it because I was really hoping we get a long year of either a continued downtrend or some flatlining in the market, because I'm trying to make as much money as I can to take advantage of this, because this is where we're going to become millionaires in the next 5 years. Buying these opportunities today, I think, is where you're going to see that excelled performance. And if you're looking for individual stocks, because my fiance owns a lot of the tech companies already, I don't tend to buy them individually. But man, Google's probably a good buying opportunity here. The valuation on metrics on Google, probably great for some growth. Amazon, you're looking at these companies that for the first time are actually trading within a favorable valuation. Obviously, to me, valuations are typically fugazi in the short term. But when you can find a stock that has a good moat, it's huge, it's been very reliable with a long history, and you actually like the valuation metrics line up, that's just like the beauty, right? The company doesn't suck. They have a long-term future. It's great. Everyone's just shitting on Google because of Chat GPT, but I don't think it's going to bring them down, over the next decade by any means. I mean, even if Google search slows down, YouTube, I wish, was a bigger proponent of their income. But I mean, look at YouTube, right? Name one streaming service that competes with YouTube. YouTube, man, they don't pay for content. They split ad revenue with the creators. That business model doesn't exist on Disney. Disney has to deal with it. Netflix has to deal with it. Amazon Prime, Apple, they all have to deal with the cyclical cycle of content. Marvel's popular today, but it might not be popular in 5 years. But there's going to be endless amounts of YouTube comments and educational stuff. Just YouTube is just such a great moat, I think, for Google in general. But yeah, there's just so much opportunity right now in this market. So, I mean, I hate that people are sidelining a lot. They're scared to invest. When people are horrified at times like this is when you buy, right? Like, I mean, October, I went heavy into the S&P, and I've been buying pretty aggressively in January with TSM. But like I said, then you start seeing these little rallies and boom, your portfolio is at all-time highs just from cost averaging. So don't be scared of these dips here, guys. Take advantage of them by all metric. Figure out what companies you like, what works for you. And there's no guarantee, so do keep in mind your risk tolerance, how much exposure works for you in these stocks. Again, if you have less money, you're younger, I would go balls to the wall. If you're younger and you're making like 6 figures a year, you probably don't need to go balls to the wall, and you could just start buying ETFs. There's a lot of things that come into play. So if you don't understand, sit down with people like myself, sit down with financial advisors, take all these perspectives into consideration, because it's definitely going to make you find your direction that works for you and lead to those kind of gains. But I'll pass the question off to you guys. I'd love to know what you think about all of this in that comment section below. And as always, thanks for stopping by. Maybe we'll do some more live streams down the road. Peace.